There have been a lot of discussions around bubblicious conditions in the AI space in particular, in that slice of the market. Do you see that there is some sort of excess building? When you look at history and how this has always played out, whether it's a dot-com bubble or whether it's the tulips over in Amsterdam, I mean, is this something that feels frothy to you?
Yes, this is something that feels frothy to me.
How do you say?
What if the hottest AI stocks are actually a ticking time bomb? Legendary investor Ray Dalio, founder of the world's largest hedge fund, Bridgewater Associates, sees unsettling parallels between today's AI frenzy and history's biggest bubbles. And he would know. Dalio predicted past crashes and managed over $150 billion at his peak. So when he says a market feels frothy, investors pay attention. This video unpacks what Dalio thinks is really inflating the AI boom and why that could mean trouble for your portfolio. But there's a twist. It has less to do with AI's tech and more to do with something structural that has changed in the economy. Which makes you wonder, could the same fuel that's propelling these stocks upward also be setting the stage for a hard crash? Let's listen to Dalio lay it out. Pay close attention to how he compares today to the late 1920s.
There have been a lot of discussions around bubblicious conditions in the AI space in particular, in that slice of the market. Do you see that there is some sort of excess building? When you look at history and how this has always played out, whether it's a dot-com bubble or whether it's the tulips over in Amsterdam, I mean, is this something that feels frothy to you?
Yes, this is something that feels frothy to me.
How do you see
That's
that
a straight
evolving?
answer to your
That is
question.
fantastic. I think that was brilliant. I wonder, how do you see it evolving? I mean, because there is this great promise, right? It's sort of the idea that the internet did come to fruition and change the world. AI might change the world, but
It certainly will, but if you're asking history, at each of the times, the greatest technological revolutions were taking place during those times. In other words, the late 20s, for example, there were more patents, more inventions in the world, and so on. And if you could take 2000 or those types of period, a lot of them are dependent. There was an interdependency between the capital markets and these in terms of funding and those types of things. So we have to look at valuations too, right? I would say in terms of, let's say, AI valuations and so on, I think it's more in the areas of applications than let's say, the superscalers themselves. I wouldn't want to be short the superscalers, but if I'm thinking about it's going to be in the users. Either the users of those technologies becoming more effective and so their profits will be better and so on, or those who will provide the platforms for the effective use of those. I think that that's an area of greater opportunity.
Dalio just confirmed it. Yes, parts of the AI market look frothy, maybe even bubble-ish. His historical parallel hits hard. In the late 1920s, innovation was exploding with record patents and new industries. Yet that era ended with breadlines and soup kitchens. Why do even real tech revolutions often come with financial bubbles? When something like AI promises to change the world, investors flood in like Black Friday shoppers at Best Buy. Their money funds these nascent technologies. It's an interdependency. Bold ideas need capital, and in boom times, capital flows like water from a broken dam. That's why Dalio says, look at valuations. Right now, AI excitement has investors paying prices that would make a lottery winner blush. Valuations have rocketed off the charts. The 10 largest S&P 500 companies, many riding the AI wave, now sport price-to-earnings ratios higher than at the peak of the 1999 dot-com bubble. These top 10 companies make up nearly 40% of the entire S&P 500. If you think you're diversified in an index fund, think again. Almost half your money is effectively betting on the AI megacap story continuing. Let's make this concrete. Jennifer, a software engineer in Austin, puts $1,000 monthly into her S&P 500 index fund for retirement. She thinks she's playing it safe, but $400 of every deposit flows straight into just 10 companies, mostly AI plays, trading at nosebleed valuations. In a normal environment, those companies might trade at 20 times earnings. Today, try 35 to 50 times. If valuations normalize, Jennifer's, quote, safe index fund could drop 30% overnight. Her $100,000 retirement account becomes $70,000 while she's sleeping. Look at history. In the late 1990s, anything with a .com flew high. Cisco Systems, a real profitable tech giant, saw its stock soar to absurd heights by 2000. After the bubble burst, Cisco stock didn't reach those 2000 highs again until 2024. Even 2 decades later, despite Cisco making real money, anyone who bought at the peak was underwater for almost a quarter of a century. Even revolutionary technology can be a terrible investment if you overpay. Dalio hints at this when he suggests the real opportunities are in the applications. Think Home Depot using AI to predict what you'll buy before you know you need it, not the flashy startup promising to build artificial general intelligence. It's important to stay rational during times of market craziness. Whenever I need a good dose of rationality, I turn to the ideas of the late legend of investing billionaire, Charlie Munger. We've put together Charlie Munger's 11 mental models for beating the market in a digestible guide to help you exploit the market's irrational swings. It's absolutely free to download. Just click on the link in the description or scan the QR code on screen to grab your copy. Now back to Dalio. What's pumping so much money into this market in the first place? Dalio has an answer that goes beyond tech. It reaches into how wealth is distributed and how the Federal Reserve has been pulling its levers. Let's hear Dalio explain the split economy that's pouring gasoline on this fire.
Do you think it's appropriate for the Fed to be cutting rates right now?
I think the picture on cutting rates is slightly mixed. And it has to do with the split in the economy, and it has to do with split in capital markets, which means you're trying to look at the economy as a whole. But what you have is in certain sections of the economy, you have an enormous amount of liquidity, enormous amount of wealth. Things are like if you're in the top 1% of anything, or which is the top 1% of the income earners, the top 1% of the stocks, and AI, and so on and so forth. Wow, there's a tremendous amount of liquidity and fantastic. And so you would say, if anything, you'd worry more about the bubble and how you start to pull the punch bowl, that kind of thing. But we have a very diverse economy. So if you're looking at, let's say, the bottom 60% of the population and the conditions of the bottom 60% of the bottom population and labor markets and so on, then you have a very, very different issue. I don't think monetary policy at all is going to be able to do that. I think that there's a strong situation where, the natural instinct is if things aren't exactly like I would like and I'd like to make them better, I should ease monetary policy. Okay, so that's now, we've learned that, right? Because every time you do that and then things go up and people are happy and so on. But there's a cost in doing that, right? The cost in doing that is that there's, one man's debts are another man's assets. And so when you artificially lower the interest rate so that it is not attractive, in a sense, to hold as an asset, and it's very attractive to borrow and buy things, that creates an imbalance. So I think that I think that discipline is not something that anybody seems to want, and yet I think it's needed.
Dalio just revealed America's dirty secret. We're living in 2 completely different economies under one roof. Picture a luxury penthouse where champagne flows endlessly while the basement floods with debt. When he says the top 1% have an enormous amount of liquidity, here's what that looks like. Apple sits on $55 billion in cash. Microsoft, $100 billion. Meanwhile, 64% of Americans live paycheck to paycheck. From early 2020 to early 2022, the U.S. money supply exploded by about 40%. All that money had to go somewhere. The S&P 500 doubled its 2020 low to the end of 2021. The benefits were incredibly skewed. By 2022, the wealthiest 10% of Americans owned 93% of all stock market wealth. The top 1% alone held 54% of equities. When the Fed threw a party by lowering rates and buying bonds, the top 1% drank Dom Perignon while everyone else got tap water. When money is essentially free for those with access, it creates asset bubbles, exactly what we're seeing in AI stocks. Check out this chart. It shows the price of the S&P 500 alongside the cumulative NYSE margin debt. Margin debt, or money borrowed to buy stocks, hit an all-time high of $1.13 trillion recently. That's like every American borrowing $3,400 just to gamble on stocks. Every time we've seen a spike like this, think 2000, 2007, 2021, it was followed by a nasty market crash. This is Dalio's imbalance. Ultra-low rates made borrowing cheaper than a Netflix subscription for the wealthy, so they leveraged up to chase gains. But the bottom 60% weren't buying NVIDIA with cheap loans. They were choosing between groceries and gas. The Fed's easy money inflated a bubble in assets without healing the real economy for the majority. The Federal Reserve is trapped like a mouse between two cats. If it raises rates to cool the bubble, it hurts borrowers and could trigger recession. If it cuts rates to help struggling families, it feeds more cash into the penthouse, inflating the bubble until it explodes. What's the endgame if nobody wants the discipline Dalio says is needed? One possibility, the bubble keeps inflating until something breaks on its own, like a game of musical chairs where the music stops suddenly. As Dalio hints, one man's debt is another man's asset. If lenders pull back, those assets can plummet faster than crypto in a bear market. Watch the credit conditions. If you see banks tightening lending or interest rates spiking, that could be the pin that pricks the bubble. With over $1 trillion in margin loans on Wall Street, anything that makes those loans expensive will force selling. A broad sell-off would hit everyone. Remember how 40% of the index is just the top 10 AI-tied stocks. A crash in those could send the entire market into a tailspin. The liquidity illusion means the market gains might not be as solid as they look. They're propped up by the wealthy's ability to keep pouring in money like quarters into a slot machine. To be fair, AI really is transformative technology, and Dalio isn't denying that. Some AI companies today will end up as the Amazons and Googles of tomorrow, but the survivors will only reward investors who didn't overpay during the hype phase. Dalio's point about looking to the, quote, users of AI is gold. Businesses that harness AI to cut costs or boost sales. Walmart using AI to stock shelves before items run out, or Pfizer using AI to develop drugs in half the time. Those might see tangible profit growth. That's different from a startup burning $10 million monthly on GPU rentals with no path to profit. As an investor, how can you navigate this? Well, first, heed the warning signs. Absurd valuations, concentrated gains in a handful of stocks, and lots of borrowing to buy in. These signals suggest caution. If you're considering an AI investment, ask yourself, am I buying at a price that assumes near perfection? Could I stomach a 50% drop and still believe in the long-term story? If not, step back. This bubble is underpinned by a decades-long experiment in easy money that showered riches at the top. That can't run forever. When the tide of liquidity goes out, we'll see who built a real business and who is swimming naked. There's also a societal angle. A blow-up when inequality is this stark could lead to public anger, political upheaval, or harsh policy responses. Dalio has warned that a bust amid big wealth gaps could be, quote, socially and politically disruptive. Are you prepared for a world where policymakers might step in hard after a crash? Investors might face new taxes or rules in the aftermath. Ray Dalio sees the AI stock craze as part of a bigger story, one where too much money in too few hands is distorting markets. The AI revolution is real, but the liquidity illusion means prices can race far ahead of reality. Eventually, either fundamentals catch up or prices come down. Use Dalio's test. Look at what you're investing in. Is it supported by real earnings and real usage, or just by interdependency with easy capital? If it's the latter, be careful. Every bubble in history popped or gradually deflated to rational levels. The winners were those who either avoided the carnage altogether or grabbed solid businesses from the wreckage at sensible prices. Our mission at Investor Center is to make sure you're in that winner circle. As Dalio might put it, the goal is to stay ahead of the cycle, not get crushed by it. Don't forget to grab your copy of Munger's 11 Mental Models for Beating the Market in the link below. And if you enjoyed this video, check out this one next, where Peter Lynch comes out of retirement to guide you on how to prepare for market crashes. I will see you over there.